You know how many people are going in and out of your property when you're flipping a house? Like hundreds, okay? There's the electrician crew, there's the plumbing crew, there's the drywall crew, there's the painting crew, there's the GC and the superintendent and the project manager, and just so many people going in and out, so many crews, so many contractors, and they can easily hurt themselves on accident, and you would be just so exposed if you didn't have your flips in an LLC.
Welcome to Life Changing Money, a podcast all about one of the most taboo topics in the world, money. I'm your host, Barbara Strehans, and we're going behind the scenes on business owners' journeys to money, success, and wealth. Let's get started.
Hello, and welcome to another episode of Life Changing Money. If you've been listening for the last couple of weeks, you have heard all of our podcasts all about real estate. It is like the season for us of real estate. We're getting into the spring, summertime when real estate is popping, but also we relaunched the Write Off Your Real Estate course. So today, if you're listening to this when the podcast came out on this day, it's the last day that you can buy the course with our promos. So you can buy the course at any time, but if you want to get all of the bonus materials, you want to go through the course with all the other investors and business owners, you want access into our Facebook group, like all the community aspect of it, you need to buy the course today. And I'm going to go through some more questions that we've gotten all about real estate investing. So you're definitely going to want to listen up. But also, for those of you that are my ride or dies, I love you all, my Life Changing Money podcast community. If you're listening to this course today, it's the last day to buy the course, and I'm going to give you something that some other people might be a little upset about because they missed out. So we gave away what I think is our best bonus of any course that we give away. We do it for the Write Off Your Real Estate course. And what it is a mastermind call that you get with 12 other real estate investors or those that want to invest in real estate, myself, who is a real estate investor, tax strategist, and my favorite lender who will give you every scenario he's ever heard and seen of as well so that you can get more properties faster. And typically, we only give this bonus to the people that buy the course live when I'm doing the Write Off Your Real Estate Masterclass. So if you're listening to this today, normally you would not get this bonus because it's too late. But if you purchase the course and you DM me at Life Changing Money Podcast on Instagram and say, hey, I purchased the course today after listening to the podcast, I will give you that mastermind call, which let me just tell you, first of all, I think it's priceless because I don't offer this service as a standalone service at all, ever. Like you can't pay for this later on. Nobody out there offers a call where you can get on with a tax strategist, a real estate investor, and a lender, and they strategize the best way for you to buy more real estate faster. It just isn't out there. So first of all, it's priceless. But also, just to give you like a monetary value, to get me on the phone for an hour is $3,000. So already you're saving $3,000 just from this bonus, just for listening to the Life Changing Money podcast. So purchase the course. Today's the last day that I'm offering this. So you're going to buy the course and then DM me at Life Changing Money podcast and I'll give you the call. But let's go into some of these real estate tax questions. So what I love about the course is I've literally compiled every tax strategy I have ever seen in 15 years of doing this for every single type of real estate investor, whether it's the first time they're buying a property, whether it's someone that is turning their primary residence into an investment property, whether it's the person that is buying 500 unit apartment complexes, or the person buying hotels. I've done it all. I've seen it all. I've invested in most of that. Maybe you're a storage unit person, or maybe you're a boutique hotel person. That's really trendy right now because Airbnb is getting harder and harder to comply with all the permitting. But no matter what type of investor you are, the course is for you because I have strategies for every scenario. All of those that I just listed, whether you're a long-term rental unit owner, you're a short-term landlord, mid-term landlord, no matter what it is, there are strategies and ways for you to save money in taxes in the course. And I say it every time, but real estate is the way to build wealth while saving money in taxes. There is just no better way. You also, when you take into account investing in real estate, you're going to take into account the cash flow you're making every month. But what most people miss out on is all the tax savings that they have to account in there as well. So your true ROI is actually a calculation, and we go through this in the course, but it's a calculation of your cash on cash return, your cash flow, your tax savings through depreciation, your tax savings through cost segregation studies, your tax savings through deductions for your rental properties, tax savings through writing off your life in your real estate, someone else paying down your mortgage, your equity increasing, the appreciation of the property. It's so many things, and real estate can make you so much wealthier, so much faster if you know how to calculate it. And it's all in the course for you in like such an easy to understand way. So we have some questions that came about from the last time we did the Write Off Your Real Estate Masterclass, which was a year ago. I can't believe it's already been a year. We only launch this thing once a year. So let's get into some of these questions after I take a sip of coffee, which is now cold and creamerless, which is like a sin. You know, I really just live for good coffee in the morning, and it didn't happen today because I had no creamer, and Instacart wouldn't deliver fast enough, so I'm sad. But question number 1, for people who buy and flip houses, what are some tax strategies or deductions they should be aware of? Is it important they create an LLC? Oh my gosh, every one of these podcasts and classes that I do, people always ask about creating LLCs for their properties. You guys, do I need to like scream this from the rooftops or say it louder for the people in the back? You need your properties in a freaking LLC. Please, for the love of all things, get an LLC before you buy an investment property. You need to be protected liability-wise. Okay, so yes, get an LLC. These people in particular, do they need an LLC for flipping? Yes, you need an LLC for flipping, even more so than having an investment property, because you know how many people are going in and out of your property when you're flipping a house? Like hundreds, okay? There's the electrician crew, there's the plumbing crew, there's the drywall crew, there's the painting crew, there's the GC and the superintendent and the project manager, and just so many people going in and out, so many crews, so many contractors, and they can easily hurt themselves on accident, and you would be just so exposed if you didn't have your flips in an LLC. More importantly, for you flippers, which just means you flip houses, I'm going to call you flippers. You flippers have an active business in the eyes of the IRS. Okay, this is not a rental property. This is not an investment property for definition purposes of the IRS. You might think of it as an investment, but really to the IRS, it's an active business because you're spending so much time rehabbing it, figuring out how you want to reconfigure it, doing the architecture, engineering plans, working with an interior designer, perhaps, like so many things. And you're in the day-to-day of it, and you're having to check on the property so much that this is an active business. So more importantly, for liability reasons, yes, you need an LLC if you're a flipper, but also you're paying way too much freaking money in taxes if you're a sole prop or an LLC and you flip houses, because you could be an S corporation and save 15.3% in taxes, which means on just $100,000 of gain that you have from flipping a house, you're paying an extra 15 grand in tax on top of federal rate, on top of your state rates. So it's crazy bananas if you're a flipper and you're not an S corporation. Okay. And then you can start writing off your life. Like, hello, not only do flippers need the write off your real estate course, but they also need the write off your life course, which you'll see when you purchase the write off your real estate course during this launch at checkout, you'll be able to get secret, don't tell everyone. You'll be able to get some of our courses for half off. So it's the best time literally to buy a course is during a launch. So flippers, yes, please have an LLC. Please think about switching to an S corporation. We even have a course all about S corporations, why they're important, why they're so beneficial. Yes, there's more compliance involved and a little bit more fees, but like every 100 grand you make, you are saving $15,000 like in your pocket. This is 15 grand you would have spent and given to the IRS back in your pocket. Like that is another rehab. That's another fix and flip. That's another investment property, another rental. That's a lot of money, 15 grand, or go on like a baller ass family vacation or buy your next dream vehicle, whatever it is, whatever your goals are. $15,000 is a lot of money. I don't care who you are. So you really need to have your properties in the right entity. You need to have your businesses in the right entities. You all need trusts and estates, which we have an entire course for that as well. So there's just so many, I could like go on and on forever. And I think that business owners, real estate investors are just so exposed because they don't have this knowledge, which is exactly why we come out with these courses. It's exactly why I have the podcast so that more and more of you can listen. And I hope you share this podcast with your friends because friends don't let friends pay too much in taxes, but also we just don't want our friends getting sued either, you know? So send this to someone you love. Next question. Can I rent my second home to the business and use it as an office space? Ooh, this one is so juicy and I can go in so many different directions. Also why you need the Write Off Your Real Estate course, because I go through every scenario like this and like so many different outcomes and ways that you could go. But let me go with my favorite way for you here. So they have a second home. They want to rent it to the business as office space. Can you do this? The answer is yes, you can rent it to your business if you don't otherwise use it as a personal residence. Okay. So that's important. This second home, you're not going to like live there, but you can rent it to the business and use it as office space. There's also something most people out there don't know about, even accountants. I see this done wrong all the time. There is something called the self-rental election. And let me tell you about what a self-rental is. A self-rental means that you're renting it to yourself, i.e. an LLC that you also own, because through attribution, which is like this IRS jargon, through attribution, it's basically you, meaning you have a business and you have a rental LLC. The business is owned 100% by you. The rental LLC is owned 100% by you. By attribution, you own the same thing altogether. If this is the case, you own your business and this property in the same percentage, you could qualify for the self-rental election. And you're going to have the business pay rent to your rental LLC, fair market value, like whatever someone else would have rented it for. Let's say this second home could be rented for $5,000 a month. Okay, so your business, maybe the business pays $6,000 a month because now it's being used for a commercial space, so it could probably rent for a little higher. So your business pays the rental LLC $6,000 a month. Why is that good? Well, your business just created a $6,000 a month rental expense. 6,000 times 12, that's $72,000 of rent expense. That lowers your business income, which is great because businesses are taxed higher Remember, businesses are taxed higher than rental LLCs. So you're saving money in tax already and lowering your business income by $72,000. Then on the flip side, on the rental LLC, they just got $72,000 of income. Okay, cool. That's fine because I'm still getting taxed less because it's a rental LLC. It's passive in the eyes of the IRS. But what I'm going to do is take a shit ton of expenses that I was already paying personally, right? This person was using it as a second home. So they probably had to pay utilities. They were having to pay the mortgage interest, property tax, insurance, all of that personally. And we now just flipped it into basically a rental expense. So we're going to lower that $72,000 by all those expenses, mortgage interest, property tax, insurance, all the utilities. We're now going to run all the repairs through there as well. We're going to claim mileage to and from the property because we have to go check on it. So we're going to have vehicle expenses. Maybe we have gas, repairs for the car, insurance for the car, DMV fees. It all depends. Are you going to take mileage or actual expenses for the car? Then we can take travel expenses to and from. Then we can maybe pay our kids because they're going to work on the property through there. So many things. You can deduct so much. So maybe we're not claiming $72K of profit. We're going to claim like $20K of profit. Cool, because you already deducted $72K on the other side. So you're still up $50K and you're taxed at a lower bracket. But here's the kicker as well. You get to take depreciation now on the property. So let's say the second home was $500,000. Well, regular depreciation on $500,000 would be like $20K a year. Oh, hey, I did good math there. Because the $20K that we had as profit after all those other expenses, we now get to take depreciation of $20,000. So what's $20,000 minus $20,000? Zero. Tax-free. We love that. Okay, so we just overall reduced our profit by $72,000, reduced our taxes by like $30,000 or $40,000 just by renting it from the business to ourselves. But here's where the self-rental election comes into play. You can do a cost segregation study on this new office space, was second home, now office space, and accelerate that depreciation. So you're not getting a $20,000 deduction this year. You could get a $120,000 deduction this year very easily. That $120,000 loss, as long as you fit the self-rental election rules and your accountant knows how to freaking do it on your tax return, which most people don't, so use us to do your taxes. But you use us to prep your tax return, and now you have a $120,000 rental loss, which normally you could not take against other income. You claim the self-rental election, and that $120,000 loss just lowered your business income by $120,000 because it nets everything together. So really, you just lowered business income by $200,000. Remember the $72,000 of rent, the $120,000 of depreciation. You just reduced it overall by $200K and saved a shit ton of money in tax. Like you could have saved $100,000 in tax in that scenario. It's literally life-changing money. You have to know these strategies. You have to get this course. Like it pays for itself in one strategy, one module. Like you're getting this course for like no money and the course is a write-off. And just one strategy will like literally change the trajectory of your wealth and generational wealth. It's so crazy. Now, the follow-up question I always get to that strategy is, well, you just lowered my business income by $200K and does that look bad? And am I going to qualify for loans and all of that? First of all, that $120,000 loss doesn't actually show up on your business. It's going to flow through to your personal return. It's going to show up in a different way. No, it doesn't make your business look bad. You can still get lending in your business. You could still sell your business for a shit ton of money. It doesn't take into account all of that. That's why you want it separate. If it was in your business, you wouldn't be able to sell your business for as much because you have this big ass loss in there. So you don't want that. That's why structure matters. Okay. But the other kicker is, as long as you have a lender that knows what the heck they're doing, so please use multiple lenders, get different quotes. Also DM me whenever you're buying a property so I can send you the people I love because I know that they know business owners. I know that they know investment properties, and I know they're going to give you the best scenario, the best rates, even if it's not them that you're using. Like literally my preferred lender, he will send out referrals like out more than he takes them in because he knows, oh, I can send this person there and they'll get 0.25% better of a rate. And that means more to him than getting the sale, you know? But the kicker is you use the right lender that knows business owners, that knows investors, and that $120,000 does not affect how you can be lended to. It does not affect how much mortgage you qualify for. It does not go into your debt to income ratio. Why? Because it's depreciation, and depreciation is always added back in. Always. It's a phantom expense to the right lender if you're using people that know what they're doing. So, no, it will not affect your business. No, it will not affect your lending. Please take the expenses that you're entitled to. Okay, I'm a new landlord and currently not making any money on it. That happens sometimes. Is there anything good or bad about that for tax purposes? Okay, the good news is, this is why I say this for real estate. You want to lose money on paper. Real estate should lose you money on paper, like I just explained, because what you're doing is saving in taxes, but you're still getting cash flow. In the scenario before with the self-rental rules, that person got way more money back in their pocket by losing money on paper. That's what we want. This person is saying they're a new landlord in 23 and not making money. They might mean they're not making cash flow yet, or their rents are not high enough yet, or they don't have the right tax person taking enough depreciation yet. So remember, some properties will not cash flow. And I know a ton of investors that don't invest for cash flow, meaning they don't care if they lose money every month. Like they're paying the mortgage, some of it themselves, because they take into account all the other ways that you're actually getting a return on your investment. They're taking into account the tax savings. They're taking into account the depreciation. They're taking into account that someone is paying some part of your mortgage down. They're taking into account the equity they're building in the property because it's going up 5% every year. And when you take all of that into account, you are making money. It's just not cash flowing. So the wording there is a little bit off maybe. But to their question, is anything good or bad about that for tax purposes? It honestly doesn't matter for tax purposes because the IRS looks at rental properties differently than it looks at businesses, right? We've probably all heard of the hobby loss rules where you don't really want to take a ton of losses every single year on your business because the IRS could come in and say, well, you're not really a real business, you're a hobby. Now, to that, I say, I've been doing this for 15 years. I've never seen the IRS ever come in to any business owner, any client I've had, and say that it's a hobby because it's very easily explainable. If you can say, I'm trying to make a profit, I just had a lot of expenses this year, it's depreciation, whatever it is, it's very easily explainable. And every single big corporation out there tries to show a loss every year on their taxes, so it's not a big deal. But also for real estate, the IRS looks at it different. The IRS knows you're going to lose money on paper on your real estate every year, probably for 27 and a half years. Why? Because that's how long you depreciate a residence for 27 and a half, 39 years for commercial property. So the IRS knows that you're going to have losses on paper. So no, it's not bad or good. It's going to be good for your taxes because you're going to save money in taxes if you're losing money on the property. But also you might want to look at ways you can increase the rents or somehow cash flow it, but also take into account all the other things like how much you're saving in taxes, equity, build up, mortgage, pay down, cash on cash return, all of that. So don't forget, the link is in the show notes here to sign up for our Write Off Your Real Estate course. Today is the last day to get all the bonuses. Today is the last day. I'm going to let you in the mastermind call. You have to be a podcast listener to get this because other people that bought the course are going to be mad that they don't get it. But buy the course today. DM me, Life Changing Money Podcast. I'll let you into our mastermind call. It is so good. So good. Let me answer one last question here and It is, can an LLC invest into a REIT? For those of you that don't know what a REIT is Real Estate Investment Trust. That's the acronym, REIT, Real Estate Investment Trust. I'm interested in our Organic Farmland Real Estate Investment Trust. I'm currently an LLC. Would there be any reason to wait until I'm an S Corp to invest in something like this? Oh gosh. Okay. For those of you investing, whether it's crypto, whether it's the stock market, whether it's a REIT, whatever it is, a rental property, please do not invest it with your business LLC. It's not good. It's called commingling. You don't want to mix your active business income with passive investments. It's just like no good. So for this person that wants to invest in a REIT, think of it like the stock market. Okay, when you buy shares of Apple, let's say there's 1 million shares of Apple and you buy a few, you own a piece of the pie of Apple. It is the same thing with a REIT. You can buy it on things like the stock exchanges and stuff, but you're basically owning a small piece of the pie of this real estate investment. So in this case, organic farmland real estate. But for the person asking, is there a reason to wait until I'm an S Corp? Like, please don't spend the money from your LLC bank account or your S Corp bank account. No, 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 no. What you're going to do is you are going to transfer. It's called a distribution from your business bank account to your personal bank account. And you're going to invest from there. Or if you have a trust set up, a revocable living trust, you could invest through your revocable living trust, but you don't want to do it through your active businesses. This is so important. I know I've said it a lot on this podcast and today, like structure matters, your entities matter, where you pay money from matters, the strategies matter. And if you do one thing wrong, it could totally blow up all the strategies, all the tax savings, and your liability protection. So please, please, please get this course so that you can be more protected, be less exposed, save a shit ton on taxes, invest more quicker. Thank you so much. I absolutely love chatting with you all here on the podcast, and I will see you next week.
Thank you for listening to this episode of Life Changing Money. Don't forget to subscribe, and I would love if you left a review and shared it with your friends. See you next time.